Now, when it comes to managing your money and when it comes to achieving your financial goals, often the simplest solution, which offers the best consistency, is the best solution. And often we talk about the systematic investment plan or the SIP as a great mode for you to deploy funds into mutual funds. To talk about the various options available within SIPs, and there are quite a few to talk about, I have with me Santosh Navlani, the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time, and good evening to you. First of all, would you agree that the SIP is perhaps the most powerful tool that an individual investor can use to build wealth over the long term?
Hi, Alex. Yeah, absolutely. I think SIP is possibly the best solution available to retail investors to participate in the Indian capital market story via mutual funds, via maybe NPS, maybe other products. But systematic investment plan, as it's called, it's possibly solves multiple problems that investors face, which is inertia, maybe kind of lack of convenience, or for that matter, even indecisiveness about whether to invest or not. SIP just automates all these decisions into actually investing in a disciplined manner and create wealth in the long run. And I think the numbers you quoted in the beginning of the show, 12,000 odd crore per month coming in into mutual funds industry every month by SIP is possibly one of the biggest reasons that India is becoming almost maybe Atmanirbhar, if I can use that word, in terms of creating or maintaining market levels or creating wealth for the kind of countrymen, and not dependent on the FII money anymore in terms of keeping the markets level up.
And I think the data points to that, Santosh, in the context of the last several months in the equity markets here. Because of the turmoil globally, you've seen foreign institutional investors that have been exiting in droves, but still you've had domestic institutional investors that have been buying quite strongly in the equity markets. But I guess that's a conversation for another day. Let's talk about SIPs. And there are various variants to the SIP. I guess to a certain extent, you can call it a tuned up engine in a car that allows you to either go faster or gives you more efficiency depending on what your requirements are. So let's deal with each of these. Let's first talk about the step up SIP. What is this concept about and how is it useful?
Yeah, Alex. So basically, all the variants of SIP are something which possibly investors should care to know once they have taken care of the basics in first place, which is starting an SIP. I think that first step is half the battle won. And as long as you do a good justice to that simple behavior of investing discipline in a disciplined manner every month, only then all these options open up for you and probably rather start to make sense for you. So step up SIP is probably one of the simplest one after SIP, in my opinion. It's very as a name connotes, step up is basically means that as you grow in life, you may want to actually automate the decision of increasing your monthly savings as well as you increase your income. And if you do that, then possibly the amount of corpus you are able to generate for yourself or gather for yourself will be far, far higher. I think it's one of the most amazing things that mutual fund industry is introduced to the fellow retail investors that we suffer as human beings from lack of change or don't liking change or even making changes to our financial planning. Similarly, what happens is people start SIP of say a couple of thousand rupees. Some people start for 3,000, 5,000, 10,000 per month instead of mutual funds. And what happens is they forget to review those amounts as they progress in life. So even in ET Money, we have seen the investors who use the ET Money app for their investments by SIPs don't really change their SIP amount every few years or a couple of years as they should. Simply because you just get used to the 2,000 rupees or 5,000 rupees or 10,000 rupees to take from your account. And Step Up SIP actually does one thing very nicely, that it increases as your income goes up. So as a name connotes the form that you will apply online or physically that you will buy a mutual fund from has an option of Step Up, and it gives you option that you want to review or increase your SIP amount in terms of percentage or a fixed amount. So I can opt to say that increase my SIP by 5% or 10% or rupees 500 or 1000. And it can be any number and I can specify a max cap. So every year my SIP amount will keep going up and it's a very healthy practice to do that. One simple example I can give, if you do SIP of rupees 5,000 per month for about 20-25 years, and you will accumulate a corpus at 15% annual rate, what will happen if you do just increment by like 10 percentage every year for the set of tenure that you do for 20-25 years? Chances are very high that you will get 2x the corpus by just increasing by 10% every month. So I think it's a very healthy kind of behavior to add to the good habit of SIP that India does. Maybe the one of the first variations you should add to your SIPs in life.
That's definitely something to consider, and I think it's a concept that a lot of people are already familiar with. I will come to lump sums later on, but I first want to talk about the various types of SIPs. There's also a flex SIP or a smart SIP. How do you understand this concept, Santosh?
Yeah, so be it flexi or smart, I don't think the names basically do justice to the power that these variations can add. And maybe for many as the beginner investors or even like just people who started last couple of years, they may be complicated concepts to understand. But let's try to simplify as much as possible. So what happens in normal SIP? You fix an amount, you fix a date, you fix a tenure. And suppose that amount is 5,000 rupees to be debited first of every month, and you do it for next 20-25 years. What happens is you basically keep investing the same amount in the same equity scheme, irrespective of market condition, which is actually the crux of SIP. Instead of timing the market, instead of thinking about whether you should be investing or not investing, how much you should be investing in that month, you automate the decision and invest every month. And what happens is, irrespective of market movements, whether they are down or going up, you actually buy the same amount. And while this helps in creating wealth in a steady manner, because markets in the long run always end up going up because the country keeps going up and the incomes start going up for the country. But the good old adage of which we've learned from legendary investors is to create more wealth, you should be buying low and selling high. And if you have reached a certain stage where you have a SIP corpus of more than a few lakh rupees, and now you want to take some responsibility that I want to multiply some of my gains without really timing the market and things like that. So mutual fund companies provide variations where you can say that if these kind of things happen, then possibly market is kind of giving a level that it's a low, and these kind of conditions are happening in the marketplace, and the market is telling me that's a bit high. So can I alter my SIP amount as an investor by actually investing lesser when markets are higher and investing more than when markets are lower? And by definition, if I do this, I accumulate more units at a lower end of the market and accumulate lesser units at higher end of the market. And because I automate the behavior of buying low and selling, or like basically investing lesser when it is high, I basically have a higher chance of creating bigger corpus. So it's a bit complicated. So what mutual fund companies have done is provided variations based on P levels, because they denote valuations based on SIP or the fund's gain on in the last month. Whether the fund is up by 1%, I'll invest less. Fund is up by 2%, I'll invest lesser. If fund is down by 2%, I'll increase my SIP amount. And similarly, there's a different variation like value SIP. What happens there is if my return expectations is like 12 percentage points annually, and I'm basically fund is up more or less 1% every month, then I'll keep my SIP amount constant. But if the fund start delivering better, I will decrease my SIP amount because I'm going to accumulate the corpus simply because the fund is delivering better. Or if the fund basically starts to return lower, then I increase my SIP amount because there's a hope that the return will be higher in the future. So basically, these are slightly more advanced nuances available to retail investors if they wish to use them. I think they can generate pretty good wealth if done rightly. And maybe people can accumulate 10 to 15% extra returns on the corpus level if these kind of innovations are put to use.
I think, I guess to a certain extent, if I can look at what happened mid-June to where we stand today, and assume that an SIP may have kicked in between that time and now, we're at the start of August. So midway through, when you saw the market reach a near-term low, 15,200 thereabouts for the Nifty 50, then perhaps you would have had a higher SIP, and where we're at right now, 17,300 thereabouts, it would have changed a little bit based on that dynamic if you had gone for something like this. There is also a trigger SIP. Is that different from the smart SIP?
So again, it's a variation, in my opinion, Alex. So trigger SIP basically is based on the some kind of event which happens in the marketplace. So for example, I'll define that a Sensex or a Nifty going down by X percentage points, I would invest. If the NAV falls by a certain percentage points, I will invest. If NAV falls to this level in absolute amount, for example, the fund that I'm investing in, the NAV is rupees 100 when I started investing my SIP for the first time. And if the NAV falls less than 90, I'll increase my SIP amount. So there are variations of smart, flexi, what do you want to call them. As I said, these names may not be the right way to put these innovations. So maybe we require better marketing in the mutual fund industry for these terms. But essentially, there are different manifestations of behaviors of buying low or buying more when the markets are lower, and buying lesser when the markets are higher. But I think one variation which is missing in the marketplace today is I would probably call it asset allocation based SIPs, where I decide which asset class I actually start buying more based on the different levels. And I think if you do that, then the return percentage that you probably can earn in terms of CAGR over long periods of time can be significantly higher compared to normal SIPs. But again, all these variations are important, good to know, healthy to follow, only when you have understood the power of simple, humble SIP.
Absolutely, very fair point. There are a couple of others also. One which is the Perpetual SIP, which I think runs without an end date. I think that's pretty self-explanatory. But there's also a concept, Santosh, with regard to a lump sum investment. That's a different approach to investing in the mutual fund industry or in any asset class, if you can stretch it to that. I think to a certain extent, it's also important to point out that that is not wrong to do. It's not a wrong approach to have, right? If you think about it, if you time it right, it can actually be very beneficial. Can you do a combination of the two?
Yeah, of course. So, as an investor, possibly who doesn't want to follow these kind of standard ways to trigger your increase or decrease in SIP based on market levels or things like that, because not every time a low P means it's a level to invest or increase your SIP amount for. Not every higher P is an indicator of you should be reducing your SIP amounts. So somebody who is probably more advanced than even this set of investors can possibly do a mix of simple, humble SIP, which basically is fixed amount every month, or maybe possibly step up SIP based on the income levels going up. And I as investor, because I'm advanced, maybe I can club a lump sum, which is possibly done in an ad hoc manner to take advantage of market situations. Let's discuss an example. So there are multiple ways where if market for as you said in June was a bit down, and if you look at right from October of 2021 till now, as we're witnessing, markets have been extremely volatile. In fact, 1 year SIP returns have possibly been negative or maybe flat for last 1 year or so, or maybe even for lump sum investment. So what as an investor I can do is let me continue my step up SIP, normal SIP as it may be. But when markets basically fall a lot, maybe 15% correction from the top, maybe 10% correction from the top, maybe I'll deploy some lump sum which I may have got through bonus, through one-time payment, one-time gains from some other asset class, or maybe extra savings that I have as an investor. And if I combine this lump sum every few months, or maybe once in a year or a couple of times in a year, I think it will do the same job that a flexi SIP can do for you. But this time, because lump sum I will decide on my own, maybe I will have better control and better decision making than a standard procedure.
I think we've provided people with enough avenues and we've explained the concept, I think, to a certain extent so that they can utilize this very powerful tool, Santosh, to build wealth over the long period. Thank you so much, as always, for taking the time.
Thanks, Alex.